Imagine waking up 2 years from now, opening your brokerage app, and realizing that the money you invested has quietly been paying you every single month. No day trading, no crypto panic, just good old-fashioned cash flow rolling in while you were busy living your life. Sounds dreamy, right? Let's rewind the clock a little. It's 2 years ago, and you've got a fresh $20,000 sitting in your savings account. You're ready to make that money work. You spent hours watching YouTube videos and reading Reddit threads. One name keeps popping up: SCHD. And right next to it, Jetty. They're like the Batman and Robin of the Dividend ETF world. Batman, SCHD, is the calm, disciplined type, while Robin, Jeppy, is the flashy, fun sidekick handing you cash every month. You decide to split your $20,000 in half. 10 grand goes into each, and thus begins one of the most satisfying investment experiments of your life. If you've ever invested before, you know that initial mix of excitement and mild nausea. You hit buy, and suddenly you own 130 to 140 shares of SCHD. We're talking about a basket of reliable dividend-paying companies like Pepsi and Home Depot that thrive even during recessions. Then comes Jeppy, the monthly money printer, around $55 a share for roughly 181 shares from your 10 grand. CHD is like planting a tree. Jeppy, it's like adopting a goose that lays golden eggs every month. In the first few months, SCHD drops quarterly dividend checks of around $100, while Jeppy gives you mini celebrations each month. Before long, you start treating those payouts like celebrations, buying lattes or reinvesting every penny. It feels rewarding. Isn't Jeppy too good to be true? A yield of 8 to 10% sounds suspicious, but its secret sauce isn't magic, it's covered calls. They sell options to generate extra income and pass that on to you. The trade-off? No explosive price growth. You won't see doubling overnight. Fast forward to year one, SCHD paid you around $400 in dividends, while JEPI, almost $900, more than double the cash flow. It's addictive and consistent. Your money is actually working, providing regular income. Team Jeppy is high-fiving over monthly payouts, while Team SCHD appreciates their gradually rising share price. Both are winning. Then October 2024 rolls around, and SCHD drops a little surprise, a 3-for-1 stock split. One day, you own about 140 shares. The next, you've got 420. Your account suddenly looks like it's been hitting the gym. Of course, nothing's technically changed. The share price is lower, but the total value is the same. Your payout per share drops too. But because you have more shares, the total income stays roughly the same. It's all psychological. But hey, psychology matters in investing. Suddenly, SCHD feels more affordable to new investors, and that often fuels demand down the road. As the months tick by, Jeppy keeps humming along, reliably dropping $70 to $80 a month into your account like clockwork. By the end of the second year, that's another $900, bringing your total to over $1,700 in payouts. Meanwhile, SCHD's price has likely crept up a bit. Maybe your original $10,000 is now worth around $11,000 or more, plus the $800 you pocketed in dividends. And this is where you have a moment. You look at your account and realize that you've been paid over $2,500 just for holding these two ETFs. You didn't chase meme stocks. You didn't try to time the market. You didn't even think about it most days. You simply said it, forgot it, and let time do the heavy lifting. Investing, if you do it right, stops being about numbers and starts being about psychology. SCHD's quarterly payouts feel like seasonal bonuses, slow, steady, predictable, always trending upward. JEPI's monthly payouts become part of your rhythm, reminding you that you're building something. Reinvesting is the closest thing to financial magic we have. It grows your wealth through compounding. 2 years in, you're already seeing momentum. Imagine what happens in a decade with SCHD's 7% growth. SCHD's dividend checks are fatter than ever, pushing $900 a year, and that's without you doing anything fancy. JEPI, it's been sending you consistent cash every single month, enough to cover groceries, subscription bills, or the occasional impulse vacation. When the market drops, you don't panic, you see opportunity. SCHD's dividends keep rolling in. JEPI's monthly income doesn't miss a beat. Imagine holding both SCHD and JEPI for 20 years. SCHD's payouts could exceed $2,000 a year. JEPI's cumulative income might top $20,000. Reinvest all of it, and your total wealth isn't just growing, it's snowballing into something substantial. Say you'd continued reinvesting all your payouts from both funds. That original $20,000 might now be $80,000, $100,000, or maybe more. Instead of $800 or $900 a year, you could be pocketing several $1,000s annually without adding another penny of your own money. If you've built a $500,000 position split evenly between SCHD and JEPI, you're looking at $30,000 to $40,000 in annual passive income. You don't have to sell a single share to get it. That means your capital keeps growing even as it pays you. Imagine getting a paycheck every month from JEPI, enough to cover rent, groceries, or travel. And every quarter, SCHD drops a larger, fatter check into your account, covering healthcare, insurance, or vacations. Nothing in investing is guaranteed, and pretending otherwise sets you up for disappointment. JEP's covered call strategy means its payouts can fluctuate with market conditions. Some months, the income might dip. SCHD's dividend growth depends on the health of underlying companies. If corporate America sneezes, your payouts might catch a cold. When you hold both, they balance each other out. JEPI softens the blow during market dips with reliable income. SCHD provides growth and upside when times are good. Investing isn't just math, it's deeply emotional. Early on, volatility feels personal. A 3% dip feels like a failure. But when you're getting paid every month, market swings start to feel like background noise. They become opportunities. This shift in mindset might be the most underrated part of dividend investing. The consistent income stream rewires your brain. It stops you from panic selling. It keeps you focused on the long game, and it gives you something most investors never find: peace of mind. When you know that money is going to land in your account every month, it changes how you think about risk. Market dips don't feel like disasters. Instead, you start asking yourself how many additional shares you can scoop up on sale. Your time horizon naturally extends. Even a small payout becomes a reminder that your money is alive and working for you, building confidence, discipline, and patience. That peace of mind has ripple effects. you might stop obsessing over stock charts and focus on lifestyle design instead. This is what people mean when they talk about financial freedom. Options. The option to say no, slow down, and build a life on your terms. The principles are the same whether you're starting with $500 or $50,000. The key is time. Dividend investing is like planting a tree. The sooner you start, the sooner you sit in the shade. Consider investing $200 a month into SCHD and VOO. That's $100 into each. You'd have $2,400 invested after the first year. But here's where most people underestimate investing. It's not about the size of the first step. It's about the fact that you took it. Stick with that habit for 5 years. Reinvest every payout and watch your investment transform. Those monthly VOO payouts, they're buying extra shares every time they hit your account. Fast forward 10 years, and suddenly that small $200 habit could have snowballed into tens of thousands of dollars. This portfolio might now generate hundreds, maybe even thousands, in annual income on its own. And here's the best part. You didn't have to time the market perfectly. It's about pairing ETFs. SCHD for dividend growth and capital appreciation. VOO for reliable cash flow. Together, they complement each other's strengths and cover weaknesses, enhancing your portfolio's performance. CHD's dividends rise while JEP provides income, making investing feel strategic. The longer you stay invested, the more this strategy reshapes your relationship with money. You stop chasing the next hot stock tip. You stop panicking when the market dips 10%. Instead, you focus on what matters: time in the market, consistent reinvestment, and a portfolio that builds wealth quietly. That's how fortunes are built, with patience, discipline, and a plan. Let's peek even further down the road. In your 20s or 30s now, starting with a modest investment, fast forward 30 or 40 years. Those small contributions and reinvested dividends could grow into a 7-figure portfolio. It's a lifestyle, retirement on your terms. If starting later in life, focus more on the income side. VOO's monthly payouts help cover expenses. CHD's dividends hedge against inflation, ensuring your income grows with your cost of living. They give you flexibility, the ability to pivot, adapt, and make choices without fear. The winner is the person who stays invested, the one who doesn't sell at the first dip. Wealth isn't built in weeks, it's built over decades. You don't need to pick sides between growth and income, you can have both. Let SCHDs build your long-term wealth, while VOO pays you in the short term, creating a sustainable portfolio. Enjoy the journey and appreciate every payout. It's about the rush seeing the dividend received notification. Watch your wealth grow in practice, knowing your money works harder than you do. So here's my challenge to you. Stop waiting for the perfect time to invest. Stop trying to predict the next market crash or the next bull run. Pick your strategy, stick with it, and let time do its thing. Because 10, 20, 30 years from now, you'll look back at those early dividends. The ones that barely covered a dinner bill, and smile, knowing they were the first bricks in a financial fortress that changed your life. You were never just investing money. You were investing in freedom, the freedom to live life on your terms. The best time to start was yesterday, and the second best time is right now. Future you is going to be very grateful you did. If this helped you see investing in a whole new way, subscribe and drop a like to help others find it. Leave a comment sharing how you're building your dividend strategy. I'd love to hear your approach. Let's talk about something that gets investors' hearts racing: putting a fat $100,000 into ETFs. Not just any ETFs, we're looking at SCHD and VOO. You drop 6 figures into these, and over the years, they'll show you 2 completely different personalities. It's like speed dating your investments. You've got $100,000 sitting in your account, deciding where to park it. No flashy meme stocks. You're going steady. You want dividends, cash flow, and an investment that feels responsible, not something that makes you check Robinhood at 3 a.m. That's where SCHD and VOO come in. 2 ETFs, same general vibe, dividends, stability, but their execution, night and day. Let's give these funds some human qualities because you'll remember them better. SCHD is like that sharp-dressed friend who knows the good restaurants. CHD screens for quality companies and strong fundamentals, never settles for less. It's selective, maybe even a little snobby. VOO, on the other hand, is your dependable workhorse buddy. He shows up with beers, wants everyone included. VOO casts a wide net, holding hundreds of companies, and focuses on steady dividends. It's less exclusive and all about inclusion. Now split your $100K, left for SCHD, right for VOO. Both will start sprinkling cash into your account with dividends. But SCHD handles payouts aggressively, growing faster than your cousin's side hustle excuses. VOO starts out higher on the yield side. It's not promising rapid growth, but it delivers a solid baseline, like a comfortable starting salary. The pay is reliable, the hours are stable, and you're not stressed. Now zoom in on SCHD. This ETF cherry-picks stocks that pay dividends and grow them. Companies like Pepsi, Texas Instruments, and Amgen. Investing in SCHD is not just about the current yield, it's about future income growth through reinvestment over the years. Think of it like planting an apple tree. You start with a couple of apples, and over 20 years, you could run a mini orchard. VOO says, why stress over picking winners when I can just own them all? This ETF spreads your $100K across over 400 companies. It's not trying to be fancy. It provides stability through diversification, including companies like Johnson & Johnson and Exxon. Like a Costco membership, VOO offers value, variety, and predictability instead of artisanal picks. The yield is similar to SCHD and may offer more cash in year 1, appealing to those who care about immediate income. In comparison, SCHD is the ambitious friend, while VOO is the steady coworker. Both stable, but with different approaches to money. With your $100,000, do you want to maximize future income potential or feel secure with wider distribution among dividend payers? It's a personality test disguised as Investum. Some people love SCHD because they want dividends to grow faster than inflation. Others prefer VOO's wide reach because they feel safer owning a little bit of everything. It's all about investor psychology. Do you want the thrill of watching your payouts grow aggressively or feel like your money is diversified enough for market chaos? No ETF is bulletproof. SCHD can be more concentrated, and that can work against it sometimes. VOO's diversification exposes you to a wider set of risks, but both are excellent funds. $100K in either isn't a bad choice. The only mistake would be overthinking it so much that your $100K just sits in cash while inflation eats it alive. Imagine you've dropped that 100K in both SCHD and VYM. At first, not much difference. Both are dripping dividends into your account. Both look stable, and you feel like a genius for not falling for the Dogecoin hype. As the years pass, little differences compound. SCHD's dividend payouts are like they've had 3 shots of espresso every year. Your income stream morphs from $3,000 in year 1 to money that feels like rent money. No constant trading, just a reinvest and chill strategy. Now flip to VYM. In year 1, you're pulling in more cash than SCHD, a nice comfortable $3,500 to $4,000. But over time, you'll see the trade-off. VYM's dividends move up slowly, like someone on an escalator. Historically, SCHD has outpaced VYM in total return, thanks to its emphasis on companies that grow and reinvest efficiently. You get stronger dividend growth, and your portfolio value itself tends to stretch a little faster compared to VYM. VYM offers stability and coverage, doing its job with a steady dividend check, but it rarely blows your socks off. Owning SCHD feels like having a friend who keeps getting promoted every couple of years. Owning VYM feels like that reliable buddy who's been at the same company for 20 years, safe and dependable. Those little differences in growth rates start snowballing in ways you don't notice until it's too late. A couple of percentage points in dividend growth might not sound like a big deal, but in a decade, SCHD could surprise you with bigger checks. Meanwhile, VYM is still writing decent checks, just not the kind that make you grin ear to ear. Psychology plays a huge role here. Some investors love upfront income with VYM, feeling comforted by it. Others prefer SCHD's dividend growth curve, willing to wait for the bigger snowball down the hill. So when people ask, which one is better, the answer is, it depends on who you are. CHD is more concentrated, holding fewer companies. That's what allows it to be picky. But it also means if a few of its top holdings take a hit, you'll feel it more. VYM spreads your money across hundreds of stocks, so no single blow can really rattle it much. If SCHD is like a hand-selected gourmet restaurant with 30 items on the menu, VYM is the all-you-can-eat buffet with 300 choices. If you're a long-term reinvestor, the gap between these two gets even more dramatic. Reinvested dividends are like cheat codes for compounding. CHD's faster dividend growth means every reinvested dollar starts pulling its weight harder over time, while VYM gives you more kernels, but at a slower rhythm. Historically, SCHD has edged out VYM in total return thanks to its focus on quality and dividend growth. That 100K in SCHD could grow larger than the same amount in VYM, with the dividend gap widening too. VYM isn't trying to be flashy. It's the steady foundation, built for stability. You get 2 different experiences. SCHD is a dividend growth machine, while VYM offers broad diversification. If you like wide diversification, VYM will help you sleep better. If you want faster growing income, SCHD is your pick. Think of it as balance. One friend pushes you to hustle, the other reminds you to slow down. So 100K in SCHD is like strapping into a sprinter, while 100K in VYM is like settling into a marathoner's steady pace. Both get you to financial freedom. The choice is simply which stride matches yours. So here's where I'll leave you. Which style fits you more? Do you see yourself leaning toward the ambitious, dividend-growing energy of SCHD or the broad, steady reliability of VYM? Think about when it comes to building wealth through the stock market, investors often ask about selecting the right ETF. In 2025, two popular ETFs are SCHD and VOO, both from reputable providers. They offer efficient diversification. While they seem similar, they serve different investment philosophies. Your choice impacts wealth growth and return stability. VOO aims to replicate the S&P 500 index, covering 500 of the largest U.S. companies across various sectors. Investing in VOO means owning pieces of giants like Apple and Microsoft, linking your returns to major economic players. The S&P 500 historically averages a 10% annual return, which reflects market cycles and economic changes. SCHD focuses on dividend-paying stocks, targeting companies with a history of strong, consistent dividend growth. Managed by Charles Schwab, SCHD holds around 100 companies that pay dividends and have strong fundamentals. The index filters for companies with at least 10 years of dividend payments and sustainable payout ratios. Enhances wealth growth not only through stock price appreciation, but also through dividends. In 2025, we're facing a different economic climate. Factors like high interest rates and inflation affect performance. The real question is which fund builds wealth faster, given the current market conditions. The S&P 500 often trades at higher price-to-earnings ratios compared to dividend-focused funds. SCHD screens for companies with solid fundamentals. In times of stretched markets, SCHD may provide better risk-adjusted returns. For investors worried about paying too much for growth, SCHD offers a disciplined approach. Expense ratios can significantly impact long-term compounding. VOO has an expense ratio of about 0.03%. SCHD is at 0.06%. Both are low-cost options, but the lower costs of VOO give it a microscopic edge over decades. SCHD offers a dividend yield of 3% to 3.5%, while VOO's hovers around 1.5%. Over decades, this can lead to significant reinvestment gains. For retirees or those seeking income, SCHD provides a built-in paycheck, while VOO requires selling shares for cash flow. One of the psychological advantages of SCHD is that investors feel rewarded even during flat or down markets. When stock prices aren't climbing, dividends still arrive, softening the emotional blow of volatility. With VOO, patience is required because the returns are tied directly to the broader market's performance. If wealth is purely about maximizing net worth over decades, VOO might have the edge in high-growth environments. If wealth is seen as growth, income, and peace of mind, SCHD builds practical wealth faster. Imagine two investors, Alex and Jordan, each starting in 2025 with $100,000. Alex chooses VOO while Jordan chooses SCHD. After 20 years, if VOO delivers 9% annually and SCHD delivers 8%, Alex ends up with more in raw numbers. However, Jordan's wealth grows more smoothly, enjoying steady cash flow if dividends are taken as income. For younger investors, VOO may be the better play in 2025. Maximizing growth makes sense, and VOO provides the cleanest exposure to US large caps. For retirees or those approaching retirement, SCHD is compelling. The yield provides income, and the companies are relatively stable. The debate between SCHD and VOO is about aligning with your financial goals. Both funds are efficient, reliable, and low-cost options. 2025 will test both growth and dividend strategies. Whether you choose VOO or SCHD, you're giving yourself exposure to America's corporate backbone. Holding VOO for growth while pairing it with SCHD creates a balanced portfolio that can weather economic cycles, offering the best of both worlds. Volatility isn't necessarily bad for long-term investors who understand compounding. For younger investors, it can create opportunities to buy more shares at cheaper prices. Historically, every downturn in the S&P 500 has been followed by a recovery, and those who stayed invested came out wealthier. Selling out due to fear at the wrong time has destroyed more wealth. SCHD offers a psychological edge. Dividends roll in during downturns. This difference affects real-world wealth building, since discipline and patience often matter more than theoretical returns. VOO is market cap weighted with technology dominating. If tech stagnates, that could hurt VOO investors. SCHD is more diversified across sectors. CHD spreads risk differently, which can help smooth returns when one sector falls out of favor. Imagine an investor holding SCHD who collects a 3.5% dividend yield in 2025. If they choose to reinvest, that yield means more shares purchased automatically every quarter. Over 20 or 30 years, this snowball effect can rival or even surpass the growth you'd see in a pure growth ETF. Academic research shows reinvested dividends often account for more than half of long-term returns. CHD's appeal isn't just about the current income, but about the compounding machine it creates quietly in the background. VOO's lower yield means you rely more on capital appreciation for wealth growth. This changes the nature of how your portfolio compounds. Tax efficiency is crucial. VOO is highly tax efficient due to minimal turnover, while SCHD distributes higher dividends, which can be taxed. For investors minimizing tax bills in 2025, this difference may tilt the scale slightly in favor of VOO. Some don't mind taxes on dividends for the reward. In a world where inflation lingers, dividend stocks act as a hedge. Companies that raise dividends can pass rising costs on to consumers. CHD's focus on dividend growers gives it an edge with companies that have pricing power, invaluable if inflation remains sticky in 2025. VOO includes a range of companies, and not all can raise prices as effectively. However, large-cap tech companies do maintain pricing power. The cushion provided by SCHD's dividends adds resilience against inflation for investors. Investors in 2025 seek diversification beyond U.S. large caps, using both VOO and CHD as foundational building blocks. The choice between SCHD and VOO is about determining their roles in your broader financial plan, often complementing each other. Together, VOO gives exposure to growth, while SCHD offers consistent cash flow, creating a balanced portfolio for any scenario. Wealth building isn't just about maximizing the number on your account statement. It's about aligning your investments with your goals. Someone in their 20s or 30s might prioritize raw growth and lean heavily into VOO. In their 50s or 60s, they might value income and stability from SCHD. The beauty of the modern ETF landscape is you don't have to choose just one path. You can combine them in ratios that match your unique needs. In 2025, if interest rates remain elevated, high dividend funds like SCHD could face headwinds as investors compare yields against risk-free treasury yields. If rates begin to fall, dividend ETFs often become more attractive. VOO's performance will be affected by corporate earnings and economic policies. Owning VOO requires a long-term mindset, the willingness to hold through downturns, and the patience to let compounding do its work. Owning SCHD also requires patience, but the psychological reinforcement of regular dividends helps many investors stick with it. Staying the course is often more important than picking the absolute best-performing fund. Both SCHD and VOO have their place in a disciplined, diversified portfolio. It doesn't have to be all or nothing. Many successful investors use a core and satellite approach, where VOO is the core and CHD enhances stability and income. This approach builds wealth through growth and consistency, crucial for generational wealth. An investor who panics and sells VOO during a downturn will never realize its full growth potential. An investor who spends all their SCHD dividends instead of reinvesting them might limit the compounding effect. Discipline, reinvestment, and long-term perspective matter just as much as which ticker symbol you choose. Both SCHD and VOO are powerful tools. I put $10,000 into 5 different dividend ETFs to see what would happen. Not theory, but actual cash in the market. I split the money evenly, $2,000 into each ETF for variety. No loading up on just high-yield funds. I picked a mix, one high yield, one focusing on growth, another on dividend aristocrats, one on boring sectors, and one international ETF. I expected high yield to give big cash but lag on price, the growth ETF to have modest income with stronger appreciation. I thought the aristocrats would be slow and steady, while the defensive one would be boring in a good way, and the international ETF was just for diversification. The first couple of months rolled by without much drama. Dividends trickled in, small payments landing in my account. Each one gave me that funny little dopamine rush. A dividend feels tangible, like actual cash you can hold or spend. By the end of the first quarter, I had collected around $90 across all 5 funds. It felt like proof that the system worked. But then things started to diverge. The growth-focused ETF was doing way better than expected, up nearly 8%. Meanwhile, the high-yield fund was handing me fatter checks, closer to 5 or 6%, but its share price was sliding. The Aristocrats fund behaved just as expected. It didn't make me rich, but it didn't give me a heart attack either. Dividends were stable. Price moved upward, but not dramatically, keeping my portfolio balanced like the designated driver. The defensive sectors ETF was similar, a bit sluggish, but during market dips, it proved its value, barely budging. The international fund was the wild card, doing okay until currency shifts impacted returns. By year-end, I collected $350 to $450 in dividends. On a $10,000 investment, that's a solid yield. The growth-oriented ETF was up nearly 10%, whereas the high-yield one barely crawled forward with losses. The total portfolio return was around 5 to 7%, depending on how you treat the dividends. If reinvested, compounding effects nudged it higher. Taking cash felt nice, but slowed growth. Dividends have a sneaky psychological effect. They make you feel wealthier than you are. A 5% yield looks nice, but if it never increases, inflation eats it alive. Watching the growth ETF outperform the high-yield one made me appreciate dividend increases. Diversification isn't just about having 5 different ETFs. It's what's inside them. The defensive ETF cushioned blows, while the high-yield one taught me not to assume fat checks equal smart investments. Taxes and fees were the unglamorous side of investing. Dividends faced cuts before I could enjoy them due to Uncle Sam's share. I didn't expect much emotion from supposed boring ETFs, yet the volatility made me question my strategies repeatedly. Should I sell the loser? Double down on the winner? Ultimately, staying patient proved fruitful. Looking back, would I invest the same way again? Dropping $10,000 across 5 ETFs seemed balanced, but revealed cracks. Chasing yield brought a bittersweet experience. High dividend checks felt good, but the dipping share price was concerning. Next time, I'd want exposure to high yields, but less than before. Maybe 1,000 instead of 2. When I first put money into the Dividend Growth Fund, I thought it would be the boring choice. Lower yield, not much excitement. But as the months went by, I watched its price steadily climb and then layered on the consistent dividends. Suddenly, it all clicked. It felt less like a quick trade and more like investing in a reliable friend who keeps improving every year. That consistency compounds into something far more powerful than chasing a high yield that fizzles out. Looking back, it's the one fund that convinced me patience isn't just a virtue in investing, it's the entire strategy. I'd happily double my allocation there. I don't mind a lower yield up front if it brings confidence in the business's strength. That combination of capital appreciation and increasing dividends makes dividend growth funds a real keeper in any long-term portfolio. The Aristocrats ETF was almost exactly what I predicted. No fireworks, just steady consistency from start to finish. Investors are drawn to companies that have raised dividends year after year. There's a sense of trust in that track record. You don't get rich overnight, but you also don't wake up to a sudden crash that wipes out months of progress. In a market with wild swings, an ETF built on predictability feels like a shield. Slow and steady proves to be powerful. The defensive sector's ETF showed me its value during a small market pullback. No drama, just slow and steady dividends. If faced with turbulence, you're glad for the stability that this ETF offers. It gives confidence, and that's worthwhile. The international ETF was probably my biggest regret. Not because international investing is bad, but the timing and currency swings made it feel like I was constantly running uphill. I'd collect decent dividends from overseas companies only to see much of the value vanish once converted back into dollars. The shine never quite lasted. Political uncertainty, shifting trade policies, and economic slowdowns made the ride bumpier than expected. It felt like having a solid player on your team sidelined when needed. Looking back, I might have leaned toward a global ETF that balances US and foreign companies. This would reduce dependency on currency moves and unpredictable events. In total, a 5 to 7% return on $10,000 isn't bad, but not all 5 ETFs pulled their weight equally. If I had funneled more into the winners and less into the underperformers, the return could have been much better. That's the eternal hindsight trap in investing. I thought ETFs would be set and forget, but I found myself checking dividend schedules, payout dates, and ex-dividend dates continuously. Dividend investing has an addictive loop. You begin to look forward to the payouts, treating it almost like a part-time job. Getting paid for holding something feels different than waiting for a stock price to rise. The satisfaction is real. I initially took dividends as cash for instant gratification. Watching those payments land was satisfying. Switching to automatic reinvestment led to real change. Even small payouts can snowball into something significant. Had I reinvested from day one, I'd have more now. A powerful lesson in how compounding works over time. Dividends aren't all created equal. Some are qualified, some aren't. The government takes a slice before you even get the chance to decide what to do with it. Watching your gross dividends shrink after taxes makes you think twice about chasing yield just for the sake of it. That experience made me appreciate growth funds a lot more, since long-term capital gains are often more tax efficient. By the end of the experiment, the lesson I walked away with was simple but powerful. Dividend investing works, but it doesn't reward impatience or shortcuts. What really paid off was balance. A mix of dividend growth funds, a core of reliable aristocrats, and defensive exposure. That combination gave me stability, a steady stream of income, and just enough growth to feel like I was moving forward. Diversification sounds good in theory, but it can feel uncomfortable and like dead weight before it helps. Currency risk, politics, and timing made it more of a headwind than a tailwind. But it's not a failure. It's about resilience over the long haul. If I were to do it all over again, I'd tweak the mix. Less emphasis on high yield and more focus on growth and consistent dividend raisers. Putting money into dividend ETFs is worth it, not for excitement, but because it's a system that works quietly in the background. It won't make you rich overnight, but thoughtfully setting it up and reinvesting can transform it into a steady wealth engine. You don't have to be glued to a stock ticker. Let your portfolio quietly do the heavy lifting while you live your life. That's my story with 10,000 spread across 5 dividend ETFs. It wasn't perfect. It wasn't always smooth. This experience taught me more than I expected. If you enjoyed this breakdown and want to see more real-world investing experiments like this, hit that like button. Drop a comment with your own dividend stories and subscribe so you don't miss the next one.